Hello, today is the 26th of July, rates decision day. Welcome to our MarkeTimers team talk with Angelo and me, David. Nothing on this program is intended as investment advice. If you intend to make investments, please make sure to consult your investment advisor. And hello, Angelo, how are you today?
Good afternoon. How's everyone doing on this Fed day? To raise or not to raise interest rates? That is the question.
Yes, so my first question will be to this topic, but let's keep it short because this video will be published to YouTube tomorrow, so it's going to be already over. But anyway, so the treasury markets are pricing in almost 100% certainty that they will raise the rates, but it's not usual that the Fed would start hiking again after a pause, right? This is not a typical behavior. And stock markets or the indices are pricing in then de facto that there will be no more hikes, no more difficulties from rates. So my question is, if we get a surprise and they don't hike, yeah, there will be a no rate hike. Because the smart markets think they will hike, and if they didn't, would it scare the markets? Wouldn't it be scary if they suddenly didn't fulfill this expectation? What do you think?
Well, I think the market's initial reaction would be bullish as far as stocks go. Okay, the stock market's reaction is probably going to be bullish because that's what Wall Street wants. Wall Street doesn't care about inflation. It doesn't care about any of that stuff. It just wants cheap money so that the party can continue. Okay. That's what I think. Now, the flip side of that coin is what happens to inflation. Now, we're already seeing here in the month of July a bottoming of commodity prices, grains, soybeans, so on and so forth. Oil has picked up some steam from roughly $68, $69. It's now trading $10 higher at about $79 a barrel right now. That's WTI. Copper isn't really doing anything, but a lot of the food stuff, milk, butter, eggs, all those sorts of things that affect everyday people like you and me, those things have begun to turn back up. So the flip side of the coin here is while Wall Street wants cheap money and they want the party to continue, does inflation get to a point like it did back in the mid to late 1970s where it started to really cause a problem for corporate profits? That's the $1 million question, and we don't know. My guess would be, yeah, I would look to see a similar pattern. But at this point, the Fed has already raised rates. And structurally, we have more non-financial debt out there. When I say non-financial, I mean government and private debt, excluding banks, okay, is at the highest levels I think we've ever seen since maybe the 1940s, early 1940s. So, the $1 million question is, what does this all look like? The problem here, too, is that with the Fed having done so much quantitative easing, and now we have quantitative tightening, what does that do to economic conditions? The hard part is we really have never been here before with this combination of dynamics in play, that it's kind of hard to discern the cause, what the cause and effects might be. If you squeeze the water balloon, it's really hard to figure out, which boogeyman of that water balloon is going to pop out to one side or the other. And one thing that's interesting that's been happening with the bond market, and I've been watching this for a while, and that is when the Fed raises interest rates by 1%, and I got this number from Gary Schilling, whose economic research I've been reading since 2004. And the studies that Gary Schilling have performed, he found that for every 100 basis point increases in Fed funds, you get roughly a 25% basis point increase in the 30-year bond yield. Okay, so if you do the math, you basically say when the Fed started raising rates at this time last year, the 30-year yield was around 3%. Now the Fed raised rates 500 basis points, so 5 times 0.25 is 125 basis points. So if you add 3, according to that historical norm, the 30-year yield should be trading right now somewhere around 430 basis points, somewhere around there, give or take a few basis points. And you'll notice that it's trading at 3.9. So what that tells me is that as the Fed has raised interest rates, buyers, whoever they may be, pension funds, insurance companies, mutual funds, buyers have actually stepped in and bought bonds as rates have been rising. And the reason I can conclude that is because the 30-year is trading well below this 430 basis point threshold that it should be trading at. Now, the 10-year yield, I didn't do the math on that, but Gary Schilling's historical estimate is that the 10-year yield will rise roughly 34 basis points for every 1% increase in Fed funds. So the 10-year is at roughly 34 basis points for every 1% increase in Fed funds, and the 30-year is roughly 25 basis points increase in yield for every 100 increase in basis points. So now the question becomes, if this were to continue, do buyers, as interest rates rise, do buyers continue to step in and buy the 30-year because they are finding that as rates increase slowly, they find that more and more attractive? And does that put an ultimate cap on how high we originally thought interest rates could actually go on the 10-year and the 30-year? So for example, the charts were telling us that the 2-year could easily go to 6%. Well, now I'm starting to question that math and whether or not that could actually happen. So we don't know. But what I do know is what I just said, is that buyers have definitely stepped in and bought bonds as rates have been slowly rising. And how can I tell? Because the 30-year today is trading at 3.9, and the threshold of where it should be based on historical norms is roughly 430 basis points. So there's that piece of it. Now, to go back to your question, what if the Fed doesn't raise?
Sorry, just a question to this idea that basically what you are saying, that 30-year bonds are traded at a premium. So there is a lot of buying because the bonds are more expensive than they should be. Because
yes,
inverse to the rates, the 30-year rate is lower than where it should be. Now, the question is, this buying, is it all part of this soft landing, part of this expectation of recession that has not arrived in the strength we expected? I mean, at the end of the last year, we all remember everybody, there was this huge consensus. I was part of it. I guess I was mistaken, that recession is coming immediately. And this is where the buying of bonds comes from, is the recession fears. So now that everybody is kind of slowly giving up on the recession, so maybe they will be dumping their bonds, and we will see maybe another sell-off or another lag in selling of bonds. What do you think about that?
Well, that's certainly possible. I think there is some credence to what you just said, in that, is there some buying in bonds because of the expected recession? I think there's some validity to that. However, I had this very same conversation with Ira Harris last week, and I presented him with exactly the same scenario. The 30-year yield is trading below where it should be trading. But then I said something to him, because a friend of mine had a conversation with the manager of a really big bond fund. And they're expecting economic growth to decline. But what the manager said was, you know what? I manage a big bond fund. I have to buy bonds. And that was the key phrase. I have to buy bonds. So there are institutions, pension funds, insurance companies, mutual funds, bond mutual funds specifically. They all have to buy bonds because they either have to maintain their investment mandate if they're a pension fund or a mutual fund company, right? And also, insurance companies and pension funds have to match assets with liabilities. So what are those assets and liabilities? Well, for a life insurance company, they have to match their investments with the life insurance policies. Well, one of the ways they do that is with bonds. So they have to systematically buy bonds. Pension funds, right? They have to match assets and liabilities. And they may be running, I don't know, a 70-30 type of portfolio, 60-40, 70-30, whatever it might be. So they systematically have to buy bonds. And the mutual fund company, that, the bond fund, well, that's all they can buy. So as cash systematically comes in, I'm going to call it the dumb money, right? Let me back up and define what I mean by dumb money. What I really mean by that is passive flows. Here in the US, we have, the 401k industry. And people have money taken out of their paychecks, same amount, no matter what. And those passive flows are flowing into the S&P 500. They're flowing into bond index funds. So as those flows keep coming in, the managers of those mutual funds have to buy bonds or buy stocks no matter what. And it doesn't matter whether Microsoft is overvalued or undervalued. It doesn't matter whether NVIDIA is overvalued or undervalued. The manager of that index fund has to buy those stocks because they're in the benchmark. Period, end of story. So these flows, steady flows that are going into bond mutual funds, in combination with pension funds and insurance companies that have to match assets and liabilities, as interest rates rise, they find these bonds more attractive than where they were this time last year. And if rates go, let's say, another 50 basis points higher, maybe 75 basis points higher, they will probably find those yields more attractive than the ones they were buying this year. So that's all I can really say at this point about the bond market. There's flows. Bonds have to be bought by certain constituents. And then there's also the part of me that thinks that there are also people buying bonds, or constituents buying bonds, because they think that this economic slowdown that we're seeing in the data will continue to get worse and push us into a recession of some sort. So I hope that answers the question about who might be buying bonds and why.
Now, you mentioned that insurance companies are a big buyer of bonds. And we know, bonds are basically crashing. It's a bear market that bond prices are just going down for past almost 2 years already, right? But if you look at KIE, this is the ETF with insurance companies. Yeah, it's now closing on all-time high. Yeah, so something is something smells.
Well, the thing about KIE and insurance companies. So you have car insurance, you have property and casualty, okay, which is car insurance, homeowners insurance, liability insurance, business insurance, which is liability, and then you have life insurance companies. Now, remember, David, that they're not all buying bonds in one shot. They're buying it incrementally. So remember, you're making your premium payment. I just sent in a check for my umbrella policy, it's called. So as their customers send in checks, the insurance company takes that money that's coming in the door every day and they have to put it to work. Now, the thing about that is insurance companies by law, at least in New York State, different states have different rules, but a lot of insurance companies in the United States kind of follow the rules of New York. And that is, they can't go out and buy stocks. A lot of what they buy is real estate, mortgages, and bonds. And that's how they match up a lot of these assets and liabilities. They can buy some stocks, but it's a very small portion of their balance sheet. So now why are insurance companies via KIE looking like they're doing very well? There's two reasons for that, because I understand the insurance industry very well. So their investment return, the insurance company's investment return is going up because yields are going up and real estate prices are going up. And number two, they keep raising premiums. So they have even more cash coming in the door this year than they did last year. So like my homeowner's policy, that went up 7% from this time last year. So the insurance companies have more cash coming in the door. And typically during hard times, during a recession, insurance companies are usually a place to go for safety because their returns are fairly stable. If you don't make your insurance payment on your car insurance, you don't have car insurance. And here in the United States, like New York, for example, you have to have a minimum amount of car insurance. It's required by law. If you have a mortgage, you have to have homeowners insurance. It's required by the bank. So you can't get around it. So just like utilities and consumer staples, for example, right? Insurance companies are considered a part of the defensive category. All right. So, earnings are probably rising and insurance companies are considered defensive. So that would explain to me why KIE is at a new all-time high. I don't know if you want to show that to the group, David.
Well, I guess this
you don't have to. You could do it later.
Maybe this is part of this first quarter, which we had GDP growth, but mainly in the earnings that were celebrated like beats, it was the nominal growth, right?
Yep.
And I think insurance policies were part of the inflation. They were increasing prices. At least I was getting messages from my insurance company that I need to upgrade. Otherwise, they will not fully cover my damages on houses because the prices have increased. So, they're also increasing the insurance policy price, the premiums. So that's where the growth is. And it's part of this kind of nominal growth optimism. Yeah, we are growing. Yeah, nominally.
Yeah.
And the funny is that the tech is actually one that is growing the worst, or they are not growing actually. and
Well, you know,
that's
take
started
Microsoft.
to go up the fastest.
Take Microsoft last night. Okay. Microsoft basically said that AI, now remember, everybody went goo goo gaga back in May and June over AI, and they chased all the AI names. Now, what did Microsoft say last night? They said two things that were important. They said AI was going to have a gradual effect on earnings. So let me get this straight. You spend $2 billion on AI stuff, and your revenue from that $2 billion is roughly 150 million. Well, that math doesn't add up. So that's issue number one, that AI will have a gradual effect. Same way that the internet back in 2000 had a gradual effect on everything that we do today. Everything that we do today was not possible back in 2000. It took time for the internet to build out, right? Discord didn't even exist back then, or Zoom, right? But it does today. And it's something that runs on top of the internet. So AI will probably be the same way, where it takes time for AI to develop and be used more broadly, right? Although a lot of companies have been using it for years, as you and I both know, David, right? But it doesn't automatically translate to profit. So that's issue number one with what Microsoft said last night. Number two, Azure. Azure sales, which is Microsoft's cloud product, sales declined again, right? Such that, where is Microsoft right now? Microsoft today is down 4.5% right now as we speak. Snap is down 19% on earnings declines. So I have been thinking that this bear market rally, I'll call it that, bear market rally.
Oh my
that,
God, we will get trolled again. We will get trolled because we are calling it bear market rally. Now, this is a prohibited. If I say on Twitter, we are in bear market rally,
well, that's okay.
So badly.
No, you know what? But David, I don't really care, because who are the trolls? Are these people that just started investing 1 year ago, 2 years ago, and they have no idea how markets work? And all they think is that if something goes up, that means something? It doesn't necessarily. It all depends. Okay. But what I was going to say was that, for me personally, I've been doing this for a long time. And I started in this business back in the 80s, when back then it was called portfolio insurance. Okay. And it was nothing like the casino that's taking place today with ODTE. Today I'm going to call what we are seeing with ODTE outright gambling. Okay. And I've been wondering, okay, they keep pushing the market. Earnings are continuing to decline, and tech earnings are ugly, really ugly. So I've been wondering, when is the moment where the psychology of the market flips from ODTE call buying to ODTE put buying, because we finally flipped and economic conditions finally got so bad that the big players can't ignore it anymore and the market shifts. Now, within that, you have to understand that the 1 day to expiration options game, right? Those players, those CTAs with their rules-based systems, they don't care about what the economic cycle is doing, because they're just playing that game for today.
Are playing
right?
the momentum.
They're playing momentum. So they play the game today. Tomorrow they reset. The day after that they reset. Every day is a new game. because at 4:15, today's game ends, and it starts again tomorrow morning when options start trading. Okay, so at some point, it's going to be real interesting to see, do we have that aha moment when the psychology and the momentum shifts to the downside because everyone realizes, holy crap, things are this bad. And even the higher end consumer is cutting back. Last night, LVMH, Louis Vuitton, what did they say? They said that sales in the United States, are weakening. They're kind of hanging in there in China, and they're kind of hanging in there in Japan. They haven't rolled over yet, but it's rolling over in the US, right? So if it's rolling over in the US, it's only a matter of time before it starts to hit foreign countries, other countries that rely on the US for their exports. So even the wealthy are starting to cut back a little bit on their spending. Now, does that mean that they take 2 vacations this year instead of 3? And maybe they only buy two new handbags this year, David, instead of 3 or 4. Okay, but that means something, and eventually that'll filter through. So while I am keenly aware that the cycle is one thing, and we talked about this during our discussion back in May. Remember, I talked about the flow versus the cycle. Well, that game, if anyone wants to go back and rewatch that video, it was Fed Day back in May, I believe. I don't remember the date, but you can find it here in Discord. Well, that game hasn't changed yet. It's still the flow versus the cycle.
And
at some point,
when we are at this,
some point, they will converge.
When we are at this cycle, maybe because we talked a month ago, has anything changed since then in the sphere of the credit cycle, liquidity? I'm following cross-border capital. What they are talking a lot about is that this disinflationary wave, it has somehow big impact on liquidity. Yeah, the lower inflation there is, the lower CPI, the bigger liquidity, kind of these algos that are crunching up the risk models, the more liquidity they can put into the markets. Actually, liquidity has not been really going down, according to cross-border capital. Lately, they are moderating. They say, well, it's not, the liquidity is not going to go up all the time. There will be, of course, some pullbacks. What do you see in the credit cards, in credit markets in general? Has the cycle shifted somewhere since last time?
Honestly, no. In fact, credit card delinquencies are continuing to rise. Auto loan delinquencies are continuing to rise. There was some data that came out last week, and it talked about car loan applications. And when you look at month over month, the amount of car loan applications, so let's just say that from May to June, car loan applications rose 10%. Well, the percentage of car loan applications for the month that were actually declined, in other words, people applied for a car loan and they got declined, the percentage of declines was actually higher than the percentage of car loan applications for that particular month. That dynamic hasn't happened in a long time. I don't think it's ever happened where the amount of declines was higher than the amount of car loan, the percentage of new car loan applications. The percentage of declines was higher than the percentage of new car loan applications. I never saw that before.
Okay, Angelo, so let me just repeat it because to make sure that our Czech subscribers understand. So basically,
It's a difficult concept, but go ahead.
applications is like when I apply for a car loan, right? And
Mhm.
I either I get the loan or I am declined. They say, no, 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 your credit rating is too low. I'm not gonna give you. So
Or you don't have enough income for this $1,000 a month car payment because car prices and interest rates are going up.
yeah, so I apply. So the applications, the amount of people who are applying for a car loan has increased. Wow, all the bulls on Twitter are like, yeah, this is bullish. But then actually the amount of declines has increased more than the application. So actually it's not a growth.
No.
It's economical, again, another indication of economical slowdown.
Yep. So if you get declined for a car loan, then you only have one option. Either you keep your car or you're going to have to buy a cheaper car with a loan that the bank will qualify you on or approve. That's it. So those two things. So now if you have to buy a cheaper car, all right, the salesman gets a lower commission. It has a ripple through effect. Or if you end up keeping your car, you go, oh, okay, well, I'll just keep my car longer. Well, car company, there's fewer cars being manufactured, right? And fewer car sales being made. It's pretty simple.
Okay, so from cars, let's move to real estate.
Oh, wait. Excuse me 1 second, David.
Yeah.
Going back to credit cards, banks. So I don't know, a lot of your subscribers probably wouldn't know this, but last night, Bank of California bought out PacWest, which is a medium-sized, I think it's a medium-sized regional bank. So it was Silicon Valley Bank, First Republic, PacWest, Western Alliance, right? These were all names that were in the news back in March. Okay, well, last night, Bank of California bought out or took over PacWest. That wasn't expected, but they did it with I think 400 million from a private equity group to take over PacWest. Now, that tells me that the banking crisis here in the United States isn't over. It's not done.
Yeah, to buy a bank for 400 million, it's like buying a whole bunch of like a bag full of shit for free, right?
So this sort of stuff is going to continue. And I think PacWest today was trading down. Let's see, where was it? So you know what? PacWest now today is up 26%. That's because of the buyout. It was down a lot this morning. And BANC is trading up a little bit. Okay. Well, you would expect the bank that's being taken over to have the ARBs, the arbitrage groups, step in and buy the stock. That's typically the way it works. So that tells us everything that we need to know. The stress in the banking system is still there. Now, I'm not talking about JP Morgan, right? Or Bank of America or Citibank or maybe Wells Fargo, right? Because those are the banks that got all the deposits. Like a lot of deposits came out of the US banking system and everybody ran to like JP Morgan, Citibank, Bank of America, and Wells Fargo. So those banks got bigger for the moment.
Ah, that was great catch. Thank you. And maybe let's move from credit because it's also related to kind of credit and rates. What about the real estate markets, housing markets, REITs, and especially home builders? I mean, home builders are at all-time high. So what's happening in the United States in the housing?
Okay. So when we talk about real estate, you have to break it down into the subgroups of real estate, because real estate incorporates industrial properties, office buildings, shopping centers, apartments, housing, right? So there's different groups there. And within that, you have to be really careful about which one you're looking at. So single family or individual housing, apartments, that's doing okay. Offices, not so much. Industrial properties, well, they're starting to, roll over because the economic cycle's rolling over. Now, single family housing here in the United States, that's a really interesting phenomenon. So when rates go up, everybody expects housing prices to decline. Okay, well, the weird thing this time here in the US is that a lot of people have mortgages, 2.5%, 3%, 3.5%, 4%. My mortgage is 4%, right? And so interestingly, the psychology of that is whereby, you know what? I'm not going to sell my house. I'm going to stay right where I am because I have a 3.5% mortgage. If I want to sell my house and go move to Tennessee or South Carolina or somewhere else in New York, I'm going to have to get a mortgage of 7%. I don't want to do that. So people are staying put. And when they stay put, what it's doing is it's putting fewer existing homes for sale on the market. So the result is there's fewer homes for sale. So the people that do want to buy a home, they're pushing prices up because there's not enough houses for sale. That wasn't supposed to happen. It was supposed to happen the other way, right? More people selling their houses because they couldn't afford to keep them, right? And thus prices roll over like they did back in 2008. Well, this time is the complete opposite of 2008. And so housing is actually holding up pretty well. And when you look at ITB or XHB, right, which is the basically home builder stuff and actual home builders and companies that supply building products like roofing and insulation and heating and air conditioning systems, right? Those companies have had a pretty good run so far this year. And that's because the home builders are building houses and people that have some money are actually buying that new construction because they don't want to, either they can afford to buy the new construction, right? Or they can't find an existing home that meets their needs. So both of those two categories, existing homes and new construction, those prices are holding up pretty good, which that wasn't supposed to happen.
This all that we are talking about leads to employment. Yes, everything is more expensive. People need to have maybe 2 jobs, but also wages are the average hourly payments are earnings are growing. So people are managing because they still have their job. Yeah. So they are managing to pay their old mortgage that is only 3 or 4%. But what is difficult about modeling this credit cycle and when the credit cycle comes to the end is the rolling of the refinancing and rolling of the debt. Because yes, the interest rates were raised very quickly. But not everybody has to roll or refinance their debt in 1 year, because it's a gradual process, refinancing. People have 10 years of debts. Mortgages are what average 20 years in America. I don't know for how many years usually people have fixed rates on mortgage. Corporates usually have four-year bond, 5-year bonds. So I don't really know, and I don't know how to research it. I don't really know, because credit cycle is about refinancing. As soon as there is a problem with refinancing, then it's going to hit. But it seems like there's no problem with that at this moment. It's going smoothly.
Well, think of it this way, David. Between this year and next year, the forecast was roughly $1.7 trillion of corporate debt that had to get refinanced. Well, that's a process, because all these companies aren't going to come to the market on the same day and try to refinance. That's not the way it works. What a lot of them tend to do is they don't wait until the last minute. They start doing it incrementally, so that by the time they get closer and closer to the drop dead date, they don't have much left to refinance. So it's an incremental process. But the thing to remember, and I think you alluded to this, is that each slice is going to be now with these higher rates. And at some point, those higher rates will have an effect on earnings if these companies don't have any pricing power. If economic conditions or inflation is such that the Fed just stays higher for longer, not cut rates, but stays higher for longer, and to me, it's looking more and more like that's the case. It doesn't look to me like inflation is going to turn into deflation anytime soon. And the reason I'm saying that is because governments are not cutting back on spending. They're continuing to spend money. We call it fiscal. And so if fiscal continues to increase, like the United States, our budget deficit last year was supposed to be 800 billion. Well, it came in at 1.2 trillion. So, that was 8, 9, 10, 11, 12. That was an extra $400 billion that got pumped into the economy, separate from anything that the Fed was doing. You see? And the US is not alone. This is going on in Europe as well. So as more and more debt gets pumped out there, yeah, at some point that'll end up being a problem. But going back to the corporate side, yeah, they're going to continue to do it incrementally, right? And they will either readjust, they'll have to readjust and right size their balance sheet, or maybe they end up going out of business, or they have negative growth. But at the moment, when I look at inflation is not below zero. So if something costs $100 and next year it costs $103, right? Inflation, the rate of change of inflation is coming down from 8, 7, 6, 5, 4, 3, right? That doesn't mean that inflation went away. That simply means that instead of costing $100, right, inflation is still there, and inflation is still compounding, and something will cost $103. But because inflation is receding, maybe it would have been $105, but because inflation is slowing down, the item only went up from $100 to $103. So make no mistake, inflation is still there and it's still compounding, right? Deflation does not happen until that item that costs $103 a year later costs $102. Instead of going from 100 to 103 to 105 to 107. Okay, so the rate of change of inflation is simply disinflating. That is not deflation, it's disinflation. because the price of that item is still actually going up each and every year. It's just not going up as fast. And that's what we have to watch very, very carefully, is that there's this insidious component of inflation where the cost of things are still going up. They're just not going up as fast. And until something goes from 100 to 103 to 105, down to 104, down to 102, right? Until we see something like that, inflation won't be tamed. But the Fed is really, really, really afraid of deflation because of all the debt. And that's why they have this 2% inflation target. They don't want inflation going below 2% down to zero, and God forbid, go negative. You can't have that, because otherwise, all of the debtors out there, all of that debt, the debt burden explodes. And companies and governments then have a problem paying their debts. And that's the end game. I think, that's kind of the end game that everybody is worried about. Some sort of debt explosion, right? Or some sort of interest expense explosion on the part of governments. And then that forces the central banks to step in some way, either yield curve control, or QE all over again. And that's the end game. And we're not there yet. But every day that goes by, we're one day closer.
Okay, Angelo, thank you very much for your excellent insights. And now let's look into what we are seeing in the markets in terms of price ranges and our MarkeTimers models. I'll start sharing my screen. Okay, so the main theme right now at this moment is commodities. We had quite strong growth of prices in June and July. As you can see here, quarter to date, this is basically July. All the components of commodities are green. GSG, the general, these are the ETNs that represent the kind of segments of commodities. GSG is overall ETN, where the major representation is energy. So that is up 9% this month. Year to date, it's zero plus 0.25%. So we don't see anymore disinflation in energy or in commodities this year. Actually, prices of commodities in general have not gone down. If we look year over year, we are still minus 4.6% on GSG. But if we look at agricultural commodities, which is DBA, year over year, we are up almost 14%. Agricultural commodities. Basic metals up 1.3%. Energy is still year over year minus 13%. But we can see, we will look later on the charts, that there's a possibility that we will see a breakout. But when we talk about energies, for example, UGA, which is ETN trading RBOB. RBOB futures are basically gasoline. I know, Angelo, correct me if I'm wrong, but the gasoline is basically a product that is used to mix what you put in a car or what you put in an airplane, right? So basically, RBOB is the closest price that you see at the gas station. The movement in UGA is the closest to what you see at the gas station, right? Angelo is muted. I don't know if he can hear this question. So in UGA, you have year over year is 14%. Of course, UGA is actually performing better than spot price of RBOB because there is a backwardation. And this is something that we see in many commodities. We see it now in oil, in RBOB. We see it in many agricultural commodities that there is a backwardation. Backwardation is when current contracts are more expensive than contracts in future. So the buyer is willing to pay extra for immediate delivery. That signals that there is kind of more demand than supply, kind of an imbalance, and it's bullish for in general for commodities. So yeah, if we look at charts now, let's look at it visually at these price movements. So let's start commodities. Let's start with UGA. As you can see, there was a very long consolidation. This is monthly chart up here. Here is a weekly chart, and this is daily chart. I mean, UGA is getting close to what, all-time high, yeah. And this is the price of gas at your gas station, pretty much, right? GSG, again, we had this downtrending channel that we see on the weekly, and we broke out, and the weekly range is green, daily range is green, the monthly is still red, so I expect there will be some significant pullback. But all time frames, as you can see, are signaling higher lows and higher highs. So we'll see if this breakout is real. We can look at oil. Oil is still, we don't see really breakout in oil yet. Oil is still in a kind of a choppy zone and a very heavy consolidation that already takes many months. But then we have commodities like wheat, where we are also seeing an attempt to break out from the downtrend. But we have, you know, commodities like sugar, which are uptrending. We haven't really seen any downtrend.
Yeah. David, excuse me 1 second. I just want to say something about commodities. So for the month of July, commodities broadly, you know, as represented by the CRB, the Thomson Reuters CRB index, commodities and inflation have easy comps for the month of July and maybe August. So what we're seeing here in the commodity space means that we need to watch this stuff very carefully, because it could mean one of two things. Like the Fed paused back in June. So did that pausing give the economy an opportunity to kind of heat up a little bit as far as inflation is concerned, right? So that's one point. The second point is the inflation base effects start to get more difficult come late August, September, October, basically the fourth quarter, you know, the back half of Q3 and into Q4 of this year. And so what we want to see is whether or not this inflationary impulse actually continues into the fourth quarter, right? Or does it roll over? Now, if it continues, you know, that's going to be a problem, because the Fed will probably have to address it. Now, if the Fed does raise rates today, maybe that helps mitigate some of this inflationary impulse. We're just going to have to wait and see. Okay, but this could be temporary, just literally for a month or two, or this trend, or this could turn into a trend, which is 3 months or more. And we're not there yet.
Definitely. We are not, but at MarkeTimers, we are on top of it. We are monitoring, and our signals are quite clear. And when the consolidation index will go deep under 50 to 45, we know what happens. It gets a really strong momentum. We saw it in NASDAQ. We saw it in tech titles. So now let's look at the situation in indices. ES futures or S&P are in very strong trend on weekly. You can see the consolidation index is really low. Weekly ranges are green, daily ranges are green, monthly ranges are green, also with a very actually extreme reading of trend. Now, with that, as you can see, the consolidation index is an oscillator, right? So when you get to an extreme, and then the next month readings are going to be lower and lower, that means that the strong trend is transitioning into consolidation. But it's always important to look at highest time frame possible. So if we look at quarter annual time frame, we can see that S&P is basically in a consolidation already. You know, we are trading the same prices that were traded in January 22, in July 21, right? So
David, I just posted in the chat the the symbol for the Thomson Reuters CRB index for TradingView. If you want to just show everyone real quick what those charts look like.
Okay, so right now I don't see the chat. Is that the DBC?
No. The symbol here, if you want to type it in, TRJ EFF CRB. So
okay.
That's all right. TRJ, E is in Edward, F is in Frank, F is in Frank, C is in Charles, Robert, Boy.
You should be able to see it now.
Okay, now hang on one sec. Let me just clear that out. Yeah. Okay. So you can see the CRB index, that's the broad commodity index. That's oil, the grains, food, all that stuff. So it just turned bullish on the trend time frame as well.
Yeah.
Right, David? But if you expand the monthly, right, it's still bearish.
Actually, monthly.
Or is it? I can't see.
Monthly right now is gray. It's already getting gray. So yeah.
Okay.
We are seeing an attempt of breakout. We might see pullback, and then we'll see if this breakout is real or not.
That's right. That's what we're looking for.
Okay, so back to indexes, because many people trade that stuff. Yeah, so one thing that we discussed in our senior traders floor is that in general, markets are seriously overbought. We have about 220 ETF and ETN tickers in our dashboard, and majority of them is close to the top of range on the highest time frame that we are following, which is a monthly time frame. And it's not only indexes and different sector ETFs and international equity ETFs that are overbought, but also commodity ETNs are overbought. Everything is at top of range. Most of the things are at top of range. I haven't seen this kind of overboughtness, general overboughtness, for a very, very, very long time.
No, me either.
So the question is, these extreme conditions, of course, melt-ups can take for some time, but they are not going to be here forever. And there will be, and the problem is that usually when there is a regular and this kind of a bull market that has years and years in it, right? Prices go up slowly, and they trade. Every price is being traded back and forth, and then it goes higher, and then each price is like really heavily traded, and we don't see that. It's just prices are they go like through water, or like prices go through oil.
Yeah, David, you know what? Let me just say, historically, and when I say historically, this goes all the way back to 1898. Okay, when Charles Dow started writing his editorials in the Wall Street Journal, which he was the founder of the Wall Street Journal. What David was just talking about is absolutely correct. You don't see big violent moves to the upside in a bull market. That's not what you see. Not once in a while, yes, because there might be some really bullish piece of news, okay? But that is not the way bull markets work. What we're seeing here, right? These big violent moves to the upside, these are characteristics of bear markets. So just be aware of that historical pattern and keep it in the back of your mind, and don't let yourself think that stocks equal the economy, because they don't. They're two different things. Okay, so I just wanted to give some context behind what you just said, David, because it's really important.
Okay, so while the large cap American indexes are strong bullish, the Russell is on the verge of breaking out to the upside, but it's still in consolidation. So we cannot say that small caps are trending to the upside, but they are on the very edge of a breakout to the upside. So many people are positioned bullish. They have been buying IWM. So we will see how that turns out. If there is a breakout, once again, I will be watching if it has follow through, or if it fails.
Yeah. You know, David, to me, RTY, right, needs to break above 1993 and stay there.
Exactly. Yeah. Maybe even needs to stay above 2000. Yeah.
Yeah. I mean, you know, my exact number is 1993, but you know, there's room for a couple of points there either way.
It's our matrix levels, right?
Yeah.
Okay. But if we look at Europe, we are starting to see a different picture. Europe was actually very early with this bear market rally. It rallied much earlier than United States. It was interconnected with this China reopening hopes. And in Europe, we are seeing something different than in the States at this moment. Let me find, yeah. So we have Euro stocks. First of all, what is important to notice that I have to switch it to quarterly, that we can see a more than a decade, 15 years old uptrending regression channel. So we are getting really close to the top of range of this channel. That is important to notice. Let's go back to monthly. And also the momentum of this bull run that we were seeing from the low of range of the uptrending channel, the momentum is dying off. You can see that on weekly, we are seeing some really extreme chop index readings. You know, we are at 77. That's a lot. So that means that this consolidation, basically we are stuck, right? The momentum, the bullish momentum is over. And my expectation is that either we go down from here, or there will be one more surprise, and we will get a attempt at breakout higher. We will retest one or two more matrix levels to the upside, and then it will fail, and it will attempt to revisit the low of the range. Now, the data from, for example, Germany are horrible. The PMIs, it's just drag. But you know what? Again, I have a mortgage, and my mortgage is 2%, and it will be fixed for another couple of years. So, you know, yeah, industries slowing and everything, but still, there are many projects that were financed in this mania after COVID, when there was all this free money. So these projects are being finished, people are still working, are being employed by those projects. Homeowners still pay a very low mortgage. So yeah, it takes time, so this is Europe. Now let's look at India, because India is one of those countries with good demographics. Also Mexico is one of those. Mexico has an advantage of this kind of transfer of industrial production from China to make it closer to the United States and maybe more secure. India is an aspiring country to become another economical power. So, you know, I'm also closely monitoring India. When we look at ETF INDA, which means that we are seeing the picture of the Indian index, but in US dollars, which is more realistic picture than if we look at their index, the Nifty 50, which of course is denominated in rupees. So, you know, of course, in rupees, we see a big breakout, but in US dollars, the breakout is maybe happening now. I don't know, but I'm definitely closely watching this. And again, it's overbought. S&P is overbought. So as soon as we have a correction in S&P, we will have also correction in India.
Yep. David, take a look at INDY.
INDY, okay. What is that?
That's the India 50 ETF.
And how is it different from
It's different. It's different from INDA.
Yeah.
It more matches up to the Bombay index.
Okay. So here
Sensex.
we are still not yet at the all-time highs, but we can see that the momentum is very strong on weekly, on monthly. On monthly, it's getting to really extreme readings. So I mean, if we get in here, if we get to the low of range, I would be considering to buy. Let's look at Mexico.
David, I have to step away for a minute, but I'll be back.
Yeah, so I will actually close it very soon because we have 18 minutes. So I just take 5 minutes and I will close it down. Okay, so Mexico has in dollar terms has gone above all-time high, so it's a big breakout. So I'm watching this regression channel, and at the low of the range of this regression channel, I will be interested to buy into Mexico. So let's hope we'll get this kind of opportunity. And I think this is pretty much all I wanted to show today. I wanted to show some improvements in the dashboard, but I will make a separate video on that. So thank you for joining our call. Tomorrow morning, I will post it on YouTube. And good luck with trading on the interest rates decision. Keep in mind that very important is the presser after the rates decision. Thank you very much and have a good day.